Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admiral Markets today on chaos theory and the value at risk, VAR. We had already a topic very similar, in fact, to chaos theory, or with chaos theory as the main topic. That was with Paul last week on Monday, I think. And today we want to dig a little deeper into this topic. That's probably not the right way to put it. Probably it's better to say how I use chaos theory and the knowledge of fat tails which occur in markets, especially what this is. This will be a topic in a few minutes. I will make this a topic then and explain to you how it affects my trading, the knowledge about this theory behind this, and also why knowing your value at risk in your trading, for example, makes sense to some extent. Still, you shouldn't overemphasize or overfocus on a pure statistical number like the value at risk. So before we start, let's have a look at today's agenda first. Today we want to have a look at chaos theory. Once again, we give a short introduction to this, and then we answer the question how we can use this in our trading. It will be two parts, in fact. So it will be how can we use chaos theory in trading 1 and 2, and then we will build a bridge there from chaos theory to value at risk, or use the knowledge around chaos theory in our trading and in our risk and money management, especially when it comes to value at risk then. And I will give you a practical illustration of this. That's me. So my name is Jens Klatt, and I'm located in Berlin, in Germany. I'm a professional trader myself. I'm an analyst. I'm a consultant. So I'm in this industry for way over 10 years now. I started out at a bank. And for further information around my person, probably have a look at my interview I did together with Admiral before we started this Trading Spotlight series. That was around 1 year ago, I think. And the link will be found in the description box once the recording of this webinar is published. As I already said, I'm located in Berlin, in Germany. And why is this noteworthy? Here, Admiral Markets comes into play. So Admiral has, in fact, an office here in Berlin, and is a global financial service provider on a global scale, in fact, with over 20 offices around the globe. And why is this noteworthy? I really like to say that over and over again, because I think it's so important, especially in a world in which we live in right now. So it's globalized, yes, but when it comes to financial questions, you probably like to talk to someone in your native language. So I mean, here in our case, this is not such a big issue. We're talking English, or in an English webinar right now, and it shouldn't be such a big deal. But when I have questions when it comes to my trading account, whatever, I'd like to talk to someone in German, in fact. So I mean, it's not an issue to speak English, as you may hear right here, but still, it's something completely different, and you feel way more comfortable when you can speak to someone in your native language. And that's why Admiral, as a global player in the financial industry here in the FX and CFD environment, is definitely a very good choice, and you should give it a deeper look. Go to the website admiralmarkets.com, and not just when it comes to service or respectively customer support in your native language, but in addition to that, on top of that, there's also it's nearly competitive less when it comes especially to DAX trading. So here in Germany, for example, when it comes to FX and especially CFD trading and CFD DAX trading, you usually talk about Admiral Markets with the best conditions out there, not just in regards to commissions and cost of trading, but also in addition to the order execution, for example, and just the quality of trading, which is just outstandingly good. And that's why you should definitely give Admiral a deeper look. In addition to that, FX offering is also one of the most attractive in my opinion, personal opinion at least, when it comes to the spreads. Have a look, give it a look, use external softwares. FX Blue, for example, has a spread calculator. You can run here a real spread you can visualize the spread, the average spread, when it comes to Admiral, but also to other brokers. It's very interesting to see how tight the spreads in case of Admiral are compared to other brokers. Yeah, and that's it on round Admiral Markets. So give Admiral definitely a deeper look, admiralmarkets.com. And now let's have a look here at chaos theory and today's topic. In fact, it's most of it is in fact text. So I want to I want to say sorry for that, because I just went through the presentation before I started here, and I just found out, well, it's a little difficult probably. It's lots of text, but I hope that I can give it I can give you a better overview of this topic with my personal way to use chaos theory and the theory behind this, and why this is an important topic in my trading, in fact. So chaos theory is a mathematical concept that explains that it is possible to get random results from normal equations. The main precept behind chaos theory is the underlying notion of small occurrences significantly affecting the outcomes of seemingly unrelated events. So that sounds very theoretical, in fact, but it's easily understandable when you look at the so-called butterfly effect. Probably I've heard about this. It's like you have a butterfly, and the butterfly flaps with its wings, and then it can cause a hurricane. So it might be that the butterfly flaps with its wings somewhere in Northern America or here in Europe, let's say, and there's a flap of a butterfly wing, and then it can cause a hurricane, for example, in the Pacific somewhere. Let's hopefully somewhere where no one lives, but this is the main idea behind this. So you have a small event at one end of the earth, and you will have a big impact at another. And that's in fact very, very interesting concept, I think. And with some deeper thinking, you will certainly see where you can already build a bridge to trading, in fact, and where a small step you make over and over again, probably. This is very simple. And when it comes to, for example, small steps you make in regards to your adaptation of your risk and money management plan, for example, how this multiplies, and where you get then a compound effect in the long term. And so yeah, with that idea in mind, chaos theory has been applied to predicting not just weather patterns, but also to the stock market, in fact. And chaos theory is an attempt to understand the underlying order of complex systems that might appear to be without order at first glance. So that markets are chaotic, let's say. This is nothing which comes as a big surprise, I think. And now the question is, okay, how can we then use this in trading? How can we use the knowledge about these small occurrences having a big impact on our lives, respectively? A small trade you might bring into play, how this could then trigger a wave of selling, for example. So one small order which is given to the market, and then you have a cascade, a domino effect, in fact, and it's triggering a wave of stop losses, for example, hitting the markets. So now this is already a very good way to understand how chaos theory is used to explain some features of system that have traditionally been difficult to accurately model, like financial markets, in fact. So what chaos theory, in fact, does is it helps enormously to illustrate probably how even healthy markets, healthy financial markets could suffer sudden shocks and crashes, so-called fat tails. The perfect example to illustrate this is probably to have a look at what happened on the 15th of January 2015, when the S&P took away the 120 peg in the Euro Swiss franc. And what happened then? So in fact, it's not really a fat tail. To some market participants, it may have come as a surprise, or a black swan is usually also something we refer to that. Fat tails, black swans. The thing is that you could somehow expect something to happen in this direction. So it's, first of all, it's not the first time that a central bank took away a peg which was installed to, in case of the Swiss economy, to help their export sector. But in addition to that, this is a manipulation of the market, which will usually not withstand the test of time. So from rather sooner than later, market developments will usually result in this case, the central bank to have to accept that it is not bigger than the market, which is already also a very important topic right now, with central banks pumping billions and trillions of US dollar, euros, JPY, pound sterling into the markets, trying to keep the engine running, if you want. And at the end of the day, the question is it really enough to keep the system afloat, in fact? And this is something which will be a topic, in fact, and rather sooner than later, I think, which has become already a topic over the last months. And right now, the calm we see is probably the calm before the storm. So because also central banks are not big enough to, or not bigger than the market. Sure, they have to some extent infinite firepower to keep the system alive, to keep the system afloat and pump liquidity into it. But still, at the end of the day, it will not be enough. And that's one thing where I have some trouble, in fact, to say now it will be a black swan once our system, our financial system, potentially explodes or implodes in this case. But it will be more like, it will be surprising by, or which triggers this this implosion of the system. So I'm very certain there will be such an implosion, but I'm not sure what will be the event which triggers it. But at the end, it's likely that the domino effect, the cascade of events which will take place then, will see some enormous volatility hitting the markets. And so with this in mind, it becomes somehow, difficult. I mean, at the end, I'm a little skeptical if there's really such thing as a fat tail or black swan. Certainly, we could say now coronavirus has been kind of a fat tail, a black swan. No one expected such a pandemic hitting the markets. In fact, is that really true? I'm not sure. I mean, is this really is it really that's true that we couldn't have seen that coming, especially with all the manipulation having taken place in the markets over the last decade after the great financial crisis? Not sure about that, to be honest. I mean, it was potentially the trigger, but at the end of the day, certainly no one has seen it coming that quickly, probably. So coronavirus itself, or the story behind this, just imagine that. I mean, if you want to explain to someone what fragility is, or how fragile our system is, I mean, then you probably explain this coronavirus development with a bet from somewhere in China, which landed in the soup of someone who infected himself with the coronavirus. And from there, the virus spread around the globe, and the whole financial system came to the brink of disaster, probably is about to fall over. See the whole system imploding with central banks losing control. But however you put this, however you define for yourself, I think at the end it becomes clear what these fat tail events, these black swans, are. It's an event you probably do not see, you do not expect, but from there's then a cascade of events which triggers. It's like, I mean, again, let's come back to the coronavirus. Let's come back to the bat somewhere in China landing in the soup of some tourist from, I don't know, Switzerland, France, wherever. And then the virus from there spreading over the whole world, and the whole global economy drifting into a recession. Central banks have to pump billions and trillions of US dollar into the system to keep the system alive. I mean, this is the hurricane I was referring to, right? So you have the butterfly at one end, so the bat somewhere in this soup in China, and then from there you have the hurricane happening out of this. And I think this is a perfect illustration. I think given the fact that we are in this current world, and everyone feels to some impact, to some extent, the impact of this event happening, I think this perfectly illustrates how this idea plays out in the real world. And so these fat tails are, roughly speaking, highly unlikely events which happen far more often than economic theory suggests. So a fat tail, from a purely mathematical standpoint, is defined as a so-called 4 sigma event, where everything which is greater than 3 sigma. Not sure why that makes sense to dig too deep into this topic, because then we're it's probably too theoretical, and we need to use too much very technical lingo here to explain this. But just imagine that. So a 3 sigma event, from purely statistical standpoints, says that usually you should expect the an event where an event to be normally distributed, and only in 1 out of 1,000 cases. So in 99.9% of the cases, you will somewhere see an event taking place here around the so-called standard deviation, or standard deviation. It's 99.9% of the cases you will find yourself in one or the other direction. Among the a normal event, let's say, what you should expect. And then there's this 1 out of 1,000 events which lies outside this box. And this is something which is highly unlikely, again, 1 out of 1,000 times, but it happens. And it happens far more often than economic theory suggests, in fact. And these fat tails is, in fact, something which is, which was already triggered, for example, when the great financial crisis hit. That was why Lehman Brothers, for example, collapsed. That was one reason. Or you've also seen the developments, or probably heard about them at least, from 1987 with the big stock market crash. And these events, these big volatility events, you don't consider them to happen often enough to take them into account when calculating the risk of a portfolio you're trading. That comes especially true when it comes to hedge funds, to money managers, to investment banks, for example. The only problem is, once this event hits, the resulting losses are so overwhelming that they can shake the whole financial system, in fact, especially when we're talking about, in case of Lehman Brothers, about the 4th biggest investment bank in the world back then, when it came to market capitalization, if I'm not mistaken. And so yeah, the financial risk of an asset or portfolio, or of assets moving one or moving more than these 3 standard deviation from current price, this is how these fat tails are, in fact, explained. So now, before we dig into this, it's a little unfortunate, to be honest. That's not step by step. However, I'd like to one sec. I'd like to recommend to you 2 books. In fact, one was already recommended by Paul in his webinar on. Let me just think about this. The 15th, I think. Yeah, it was the 15th of June. Here, it was the book from Bill Williams here on trading chaos, applying expert techniques to maximize your profits. And he was using a technique within this webinar, which also covered fractals. Fractals was something we also made a topic. That was one of my topics here during such a trading spotlight webinar. And he presented a strategy, which is used here from Williams in his book. And he's not just making chaos theory here a topic, but also fractals, how to apply this on trading. But in addition to that, there's something very interesting when it comes to fractals themselves. And this is a highly recommended book from my end, The Misbehavior of Markets, a Fractal View of Risk, Ruin, and Reward. And the book was, in fact, published from a guy you probably have heard of. It's from Benoit Mandelbrot. And I have it here, but this is the German version of it. So it's not the English version, but I've read it in German. And yeah, what is he talking about here? So the backside, I think it's called it, says that Mandelbrot is the founder of fractal geometry, and used it to illustrate, to calculate the unpredictability of financial markets. And he's one of the founders of this theory, in fact, so fractals in general. And it's illustrating how not how charts, but how prices in financial markets, how they happen, and why it is possible then that markets can move in one or the. Oh, by the way, I'm sorry, I have no. That's not very smart. Let me just here. There's the link. There we go. So I'm sorry. I just have Mandelbrot here with the title of the book, but not the link. And he explains it in a very, very fresh, refreshing way, in fact. And I highly recommend it to read it and to dig deeper into this topic. And now the question nevertheless comes into play. Okay, well, very interesting. Still, I mean, Mandelbrot is a theoretic, or it's a mathematician. So some of you probably wonder, is it really necessary to know that? Is it really of worth for me if I want to know where to buy, where to sell when it comes to trading? In my personal opinion, I'd say yes, because it illustrates you several things which are of high importance when it comes to calculating risk, and also when it comes to overconfidence, I think we can call this, when it comes to overconfidence in markets in general. So I could imagine there have been plenty of times where you were sure that this or that would happen, in fact. And by the way, I don't want to exclude myself here. So from time to time, I have a very strong opinion about the market too. And I'm more than once surprised to see the market to behave completely different, which shows me over and over again that it's probably better to step back a little, or let's say, put it that way, have the strong opinion. Yes, I think that's a fair way to put it, but nevertheless, don't take your opinion as really as something which is guaranteeing you that the market will do this or that. And to keep this potential of being on the wrong side here in mind, leaves you with no other choice than to definitely calculate your risk accordingly, respectively, place your stop, and know where to exit the trade once the identified advantage, once your edge is not given anymore in the market. I think this is very, very important. And I think in this context, to understand this, and to really understand how important risk and money management is, the philosophy behind this, I think it definitely makes sense to also dig into this topic in more detail, and also from a theoretical standpoint, and then look at such great ways to illustrate the unpredictability of markets with concepts which try to explain them, like fractals, respectively, to understand that chaos theory here plays a very, very important role to really to grasp this concept respectively, to get a feeling for that, and really understand that markets cannot be predicted, in fact. And so still, we want to dig a little deeper into this. So it's not just text and me talking, but I want to now illustrate to you where a very fascinating tool like the value at risk probably finds a border, and where you have to keep this in mind, in fact, and which will probably help you not to misuse this concept, in fact. So I write it here right at the beginning. So in my personal opinion, again, Paul worked very well out when showing how to use chaos theory in trading, how to combine it with fractals, how to use the work from Bill Williams here, and then to apply to a trading strategy. Still, it's not my way of trading, and that's why I consider chaos theory in general, or trading based on chaos theory in general, as something which is limited, at least for me, but it still helps me in the following way. So when I look into chaos theory and when I understand what this means, it helps me to understand that these fat tails exist in trading. So it's a very good way to help you understand why fat tails, why the potential of flash crashes happens all the time, over and over again, and that these events happen far more often than economic theory suggests. So to make it very simple, let's put it simply, let's have a look here at our trading spotlight community. Okay, so this is where you can ask all your questions. By the way, if you have any questions now, right here in the webinar, or when watching the recording, please feel free to go over to the Traders Yard community. So here's the link. And please feel free to ask all your questions. So we're here for you, we're there for you, and that's exactly the idea behind this. And as you can see here, by the way, we have already over 130 people who joined us here, so feel free to join us here too. But now let's come here to my thoughts in regards to how to use chaos theory, or the potential of such flash crashes happening, even though it's very unlikely they happen, but they happen. And I'm fine with that. That's one of the reasons why I always using hard stops, and I place them. And yes, it's sometimes really annoying to see the market drop against you and see your position being stopped out, and then just seeing the market turn around again. But in the long run, it plays out. And but this is not the only way how I use chaos theory and how it affects my trading by placing stops. But when looking here at my daily presented intraday setups on the S&P, it's different. It's different than here when it comes to the DAX setup. So the basic idea behind this is in fact the same. So we're talking about a range which I define, and then I trade the breakout out of the range. And I have an advantage here, which I calculate, or which I identify thanks to a moving average. And in case of the DAX setup, for example, here, I'm placing a take profit, and it's clearly visible. So for everyone, I place the setup here, and you can see it, and there's the snapshot from the chart, and you can see also the take profit here. So now, when looking at the S&P setup, you can see, okay, there's a stop loss, there's the entry level, but there's no take profit. At least not at first glance. So you can see here that I say trade will be taken out at 9:50 PME in current environment, Central European summertime. So usually CET, now it's CEST. And this is the case if the trade is not stopped out before. So it's a time stop out, or time take profit if you want. So I exit the position at 9:50. Now the thing is, and this is something I haven't said so far, but now is probably the perfect time to say that there is in fact a take profit. It's placed 10 R away from here the entry price. So in this case, it means if we calculate the difference here between 3,055 and 3,023, the difference is 32 points. And my take profit here, there's said it's no take profit placed, but I have a take profit placed 320 pips away, or points away, in fact. So just to make to put this in perspective, we're talking in the current environment, we're talking about a take profit which is over 10% far away from my entry price. So it's not relevant, and this is most of the time the case. But there have been times in the past, just look at what happened not just during the Corona lockdown in March, but also you can go back to February 2018, for example. There has been a time when there was such a flash crash happening, May 2010, for example. So over and over again, these highly unlikely events where the market pushes higher or drops 10%, they happen, especially on the downside, especially when they are dropping. And that's why the knowledge and the knowledge around the theory behind chaos theory leads me come to the conclusion that it makes sense to have these, I call them fishing limits, if you want. So I try to fish, and I'm not I'm hunting for these flash crashes, and I just hope that such a highly unlikely event will take place, even though I know most of the time it won't happen. But if it happens, once it happens, I'm positioned already, and I have take profit placed at a level where no one expects the market to push through, or to push to in this case. And this is how you can find this, idea behind chaos theory in my trading. So I have these take profit levels which are far away and not really reachable for the market under normal market conditions, but I know that fat tails happen, flash crashes happen, and chaos theory is the explanation behind this, or it gives it life, and I understand what's happening there, and that's why I'm working with these let's call them worst case take profits. So worst case for the market, but in my case, a very lucky environment, let's say. So now let's come back nevertheless to our webinar on value at risk. You probably recall this. It's some weeks ago. And I announced, or I mentioned there, that active risk and money management is key to long-term success in trading. And traders should be really careful, especially when it comes to risk and money management tools like using this value at risk. And why is that? Well, it's because value at risk does not measure worst case losses, but it just gives an idea of what you can expect to happen in, let's say, 95% of the cases, or 1 out of 20 months if you're looking at the monthly performance. So for example, if we have a value at risk of 5% in our trading, that means nothing more than our loss is in 1 out of 20 cases 5% or greater. So just, and this is very theoretical now, and that's why I prepared something already here. So 1 second, please. I will explain to you what I do right now. Why do I do that? Oh, that's not working. 1 second. Let me do it again. So I want to avoid here the big banner from another broker on the left side. It doesn't, to me, doesn't look very professional, to be honest. What do I have here? So just to give you an idea of where I can get data from and then calculate a value at risk, and what we will do in a few minutes here. So we can go to the website investing.com, and they give you a chance here to look at markets, indices, but also ETFs, commodities, currencies, everything. But here we look at indices, and then we can go over to the S&P 500, which I did here right now. And then you can here calculate historical data. And the great thing about this is you can go back. I mean, I went back to 1990 now, but I think you can also extend this even further. I'm not sure whether that makes sense or not, but what I did here, I calculated the monthly end data, or the monthly data from the S&P 500 prices, in fact, and downloaded them. You can download them here with the CSV file. And what I now did is I uploaded them in Python. So what I did here is, this is Jupyter. This is a very great environment for doing such calculations. In Python, it's from Anaconda. So it's also for free, by the way. So if you're familiar with coding, or if you're using a programming language just like Python, you already know what I'm talking about. To everyone who is new here, this is Anaconda, and there you can get this Anaconda environment in which you find this Jupyter notebook environment, and where you can use the programming language Python. And so what I did here is very simple. So here, these are 4 steps I went through. I imported some libraries. First of all, here, matplotlib. This is to get this, to have an to be able to plot here the data, but also I imported something which is called pandas. Panda libraries. These are ways to manipulate, if you want, Excel data, and to get such an illustration here. And then in addition to that, I don't want to go to this again here. I imported, for example, NumPy. NumPy is a way to it's like work with numerical data and calculate, for example, standard deviations, and what else do we have here? Standard deviation is probably the most common one I use here, for example. And I'm importing also, for example, here a SkyPy stats, import norm, for example, and all this to get an idea on the value at risk, to calculate it, in fact. So this is some programming I do beside that. But what we want to look at here is how I use this historical data. So what I did is I downloaded this file back to 1990, in fact, historical data, and this is how it looks like. So I had to manipulate it already a little. So, for example, get dots for commas and all this, but all if you play around a little, 3 steps or something, this is what you get if you import the data here. And if you use the separator here, this semicolon, in fact. So you have the date, you have the price, and then here at the end, you have the change in percentage on a monthly basis. So we talk about May 1990, for example. And then I recalculated it, so without the percentage term here, but I have it now in a pure number written. So 0.092, it's 9.2% in this case. So, and then what I did is, in fact, I used here this last column, and what I did was I calculated the distribution of these changes here. In fact, this is what I do here, what I plot down here, and there you can see already that most of the time, most of the months I'm looking at here is somewhere slightly above, somewhere around 1%. So this is the highest, plus 1%, in fact. But there's also times once a month here, for example, has a minus of minus 15%. Sometimes here it's probably minus 17.5, something like that. So this is how you can understand this. This is like every month taking place, and then you sum them up and you illustrate them here. You plot them in that way. And then, and this is now the step where it becomes interesting. What we do is we can here calculate a confidence level, respectively our value at risk. And if we look here now at 95%, this is what I already talked about when I said 1 out of 20 months. So 95% means that in 5 out of 100 times, what is happening? 1 out of 20 times or 5 out of 100 times. So where do we find ourselves in a worst case scenario? So what means nothing more than 5 out of 100 times and more than that, what is statistically to be expected, in fact. And when looking at this number, 95%, what you have here is the value at risk of minus 0.062. That means that in 1 out of 20 months, or in 5 out of 100, but we go for 1 in 20. So if we go at 1 out of 20 months, we should expect, from a purely statistical standpoint, and given historical data here, when it comes to the S&P 500 monthly data we are looking at, we should expect in 1 out of 20 months, the loss of our investment in an, let's say, S&P 500 ETF, for example, it should be 6.2% or greater. So that's the loss we should expect here. In fact, in 99% of the cases, our loss on in 1 out of 1,000 cases here shouldn't exceed 9% on a monthly basis. So now, and this is the great thing, look at what happened just 2 months ago. So within 1 month, I haven't looked it up now, but I think the performance of the S&P, let me just have a look here. I want to do the following. I go here to trading, and I go to the historical data, the S&P. Oh, by the way, there was also another way. We could also do it another way. We could go here and just say head. So there you get the last 5 events. So what you have here is March 20. So we don't need the data itself. So we have 12.5% here, 12.5% minus 8.4%. So 2 months in a row, February and March. They lied. They could be found outside this, what we should have expected from a pure statistical standpoint. 2 months in a row, in fact, the market has dropped significantly. And by the way, this is month-end data, so we're not even looking at the floating loss. Probably you have seen that losses in the S&P have been far beyond 20%. So the portfolio you had in an S&P 500 ETF was greater than 20%, in fact. And so this is just monthly end data. And so when looking at these numbers here, you can now see, okay, it's a great way to play around a little, to get an idea, to trade from a mental stable perspective, let's call it, because you have a good idea what is likely to happen to you, to your portfolio. So in this case, we're looking at the S&P. You can do this also for trading strategies. So you just export the data and you have your daily results, let's say, and then you can calculate this 1 out of 20 days. What shall I expect 1 out of 20 months, and so on and so forth. You can play around. So I just want to, for illustration purposes, work with the valued risk here. But now the problem comes into play. We have already a good idea, and I think it's a good starting point. But at the end, it becomes also clear that here the value at risk is looking at, let's call it, normal market conditions, which is not necessarily given all the time. Look at what happened 2 months, 3 months ago with the Corona lockdown and the high volatility hit in the markets. So you have already an idea, but it's not the end. It shouldn't, for you, it shouldn't be the end here. Stop there, because chaos theory leaves you with an idea that markets and developments in markets are not just not predictable, but they are beyond that. They are they could be really devastating moves to your portfolio. And that's one way to look at chaos theory and how to use it, and then play around with also quantitative approaches, like using coding language like Python. Play around a little and find out at the end that markets can behave to some extent in some very brutal ways, in a very brutal fashion, which will naturally leave you with the understanding why risk and money management is crucial to your overall and long-term success in trading, in fact. Yeah, and that's it on my thoughts on chaos theory. So to sum this up, the main precept behind chaos theory is the underlying notion of small occurrences significantly affecting the outcomes of seemingly unrelated events, or the butterfly effect. A flap of a butterfly's wing in China can cause a hurricane in Florida, US. You can certainly use the bat effect here for a bat with the coronavirus, where the virus within a bat here in China, in a soup somewhere in China, a tourist looks at as an interesting odyssey for his as a how can I say that? So to just try something out. Let's say, yeah, a bat soup, let's say, and then it can cause a hurricane. Probably a hurricane for Mr. Trump in Florida. So let's put it probably that way, and that picture in your head. And let's come back to the topic. So while the usage of chaos theory seems limited in trading at first glance, once understood, it re-emphasizes how important risk and money management is. And in addition to that, it also points out that stop techniques based on value at risk are not necessarily something for retail traders, but institutionals with deeper pockets. That was something I also referred to in the first webinar. Remember a situation in the film Margin Call, and there when this the quant was standing here in front of the screen and trying to explain to this to his head trader or head of risk management, whatever, what had just happened over the last weeks, in fact, and no one really recognized it, that the volatility in the markets left the volatility in the portfolio of the investment bank. They were obviously looking at Lehman Brothers. The exposure was so high, the leverage they used was so high that at some point, the volatility in the market here exceeded the equity of the bank and resulted in bankruptcy then of the investment bank, in fact. And that's why what I refer to institutionals with deeper pockets, but also these institutionals with deeper pockets, they have limits to their pocket depth. And if you push the envelope piece too far, let's say, you will probably rather sooner or later result in a very, very unfavorable situation, which can collapse your hedge fund and your investment bank. So retail traders, as I myself consider myself a professional trader, can also be a retail trader, no question about that, should stick to hard stops in their trading. And this is something I do, and I do that because I know that markets can, how did Keynes say, can behave far more longer, irrational, then the trader can stay solvent. And this is something which is especially true when looking at using risk calculation tools as value at risk. They have high value if you know how to use them correctly, but it's more from a psychological perspective, respectively, to calculate also your position size, and also to see what you can expect given the historic returns of your strategy. And also how big your position size should be, to not over leverage your account, for example. But still, at the end, when it comes to trading, day trading especially, using hard stops, there's no question about that. And so don't forget to join us next time. Paul will be here on Monday, not Wednesday, on Monday, and teach you about trading the morning and the evening star patterns, including what are the morning and evening star patterns, where do we find them on the charts, how do we trade markets using these star formations, and will be on Monday, 29th of June, 2020. By the way, when it comes to candlestick patterns, one thing, in July, there will also be another event with me, and I will present to you also some statistics behind, in fact, the evening star. So we are not looking at morning stars, but we are looking at the evening star as one pattern from a purely quantitative perspective, and how often it was profitable in the past. But no, let's come back to Paul's webinar. So check your inbox for the webinar link. If you're listening right here now, you will send it, send it to your inbox and just check it out. If you watch the webinar on YouTube, please feel free to leave a comment in the chat box below, or leave a thumb up here, thumb down, hopefully a thumb up. If you want to register for the events here, for the live events every Monday, Wednesday, and Friday, then head over to admiralmarkets.com, Educations tab, Webinars, and there the Trading Spotlight webinar series. And there's the website, admiralmarkets.com. Here are the contact details. This is the risk disclaimer. And now, all the best. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. See you soon, and bye-bye.